Thank you for joining me. I'm Juan, lead trader and founder of Prosperity Trade. In this video, I want to talk about Pfizer. They've recently had their COVID pill. Is it a good investment? Is it a value play? You're going to want to watch this video. So Pfizer recently came out with their pill, and they're estimated that this pill is going to be able to cut COVID-19 deaths by 90%. And they received such positive news from the studies that they actually cut the studies early, and they're going to apply for FDA approval. And they're estimating that they should receive an FDA approval decision within weeks or months. So it's looking really positive for their COVID-19 pill. How does that translate for price and value? So there's going to be hype. There's going to be an increase in price based off of hype. Just like GameStop at $100, anybody who would have looked at the financials, of course, is going to say that it's overvalued, which is understandable. But, hype can always move stocks. So we want to make sure we understand that when we invest our money into something, are we investing into hype or fundamentals? What do the numbers tell us that this stock or this company should be trading at? And of course, we can give an estimate, we can give the intrinsic value, and it can double, triple because of the hype that comes with it. But that's not going to happen 9 times, 8 times, 7 times out of 10. So if you trade this based off of potential hype that you think is going to come, then you're treating it like a swing trade, which is fine, but just approach it as a swing trade, not as a long-term investment. And if you're going into this as a long-term investment, then let's take a look at the numbers and try to decide if the intrinsic value is worth holding this for the long term, or is it a little bit overvalued because of the news that they received and we should hold off. So if we look at their year-over-year revenue growth, in 2011, 61 billion, 2012, 54, and then they kind of averaged out between 50, 49, 50, 50, 40 in the 18th, and jumped up the last 12 months to 70 billion. Big jump. So that's the first red flag, right? If you're investing long term, it's a value play. You don't want to see major jumps like that, because is it a seasonality thing? Is it just the majority of that revenue? Is it COVID related? Now, if they're making a pill that's going to cure COVID, how much of that revenue from the vaccine is going to drop, or are people still going to have to take the vaccine? So these are questions you're going to want to ask yourself. You're basically saying, okay, it was a big jump in revenue. Is that big jump sustainable? Is that the new ceiling? Is that what they're going to start making every year? That's what you have to estimate. You have to forecast, okay, is this going to happen for the next 5 years? And that's on you. That's your due diligence. I want to go off the numbers that are in front of me, and I'm going to say this is an anomaly. This is a big jump. I think they're eventually going to get back to that 40 to 50 range, which is not a terrible thing. I mean, you're making 50 billion a year. That's not bad by any means. So what does it cost to get us this revenue? Not much, right? It's not a big gap. Most pharmaceutical costs, the direct cost of revenue is not going to be terribly as much as the indirect. It's usually they spent a lot more money on R&D, selling, general and admin expenses. And that's usually a lot of pharmaceutical companies. You see it that way. So you see here, for example, cost of revenue, direct cost is 8 billion, but the indirect cost total is 23 billion. And that's, and this is even not too bad. I mean, for a pharmaceutical company, usually they have to take a lot of their revenues and reinvest it in R&D because they have to make the next pill. Then selling, general and admin expenses because they have to market it and they have to sell it. So that's where a lot of their profit goes. And that's one of the issues, or, one of the risks, I would say, with pharmaceutical companies. They have to constantly keep reinvesting in themselves in order to stay profitable. And one bad headline, one FDA non-approval, a few deaths or something from their medication, then regardless of what the financials say, it's going to tank. So that's kind of like the risks you have to be able to live with if you're going to invest in it. So knowing that, when we do the DCF, you want to make sure there's a large enough gap between what the value of the company is and what the upside is, just in case we get one of those bad headlines. And then their net income, what they take home, is about 9 billion a year. So that's good. It's not bad. And they have plenty of cash flow to pay out dividend. My only concern, though, is that they do have a good amount of debt, and they recently diluted some shares. They're not too bad with their shares diluting. So they actually, from 2011, they had 7.8 billion shares. it dropped quite a bit. Every year they've been buying back shares. But for some reason, 2025.6 billion and not much. They diluted just a little bit. I mean, barely anything, about 50 million shares. That's not bad at all. I mean, I wouldn't even count that. Is it a sign? Okay, are they going to start diluting shares because they're priced at an all-time high? So is this a sign that they're not buying back shares? I don't think so. It's maybe just somebody sold some of their shares. Okay, if we look at their balance sheet, and total cash 12 billion, long-term debt is 35 billion. They're able, within a few years to pay off all their debt, which isn't bad. So it's not terrible. Just a few minor signs. So like I see like they diluted very small amount of shares. They have been cutting down on their workforce quite a bit. So, these are things that deserve a little bit more due diligence if you're bullish on this, if you're going to invest in the long term. So now let's look at their cash flow, their free cash flow. They've always had about between 15 and 13 billion, 14 billion and 17, 13, little drop here, 9, could be acquisitions, could be research, could be $1 million, buying back some of their shares, the dividends they paid out or whatever. But they have enough cash flow to pay out dividends and reinvest in themselves. Now, some analysts are estimating that they're going to have over 25 billion in cash flow because of the vaccines. So that's a great sign. That's if you're bullish, that's something you want to see. What are they going to do with that cash flow? They can make an acquisition of another company. They can reinvest in themselves. There's so many things that they can do with all that extra cash flow that they're going to have. So again, a few more things. Revenue has been averaging 70 billion. The total debt, 39 billion. Total cash, 21 billion, which is good. That's a good sign. Something we said we like to see. They can pay off their debt within a couple years. Now let's look at the chart real quickly. So if you see here, this company has been averaging anywhere from the 40s to the low 30s. This has been the range, right? Based off the free cash flow that they've had, based off their intrinsic value, based off of everything that we've discussed. And this recent spike, this is what you want to ask yourself. Do I want to invest now, right here, because of this? What's causing this recent spike? Well, it's all that extra revenue that they got from COVID-19 vaccine. Now, this recent spike here is from the pill. So you want to know if it's sustainable, because if you buy it here and then it just goes back to this normal channel, then you're not really getting the best out of your investment. So this is free cash flow DCF. I start off with a free cash flow DCF because it's quick. I just get the free cash flow. I estimate what they're going to continue to make. I have a discount rate. I take into account their perpetual growth, and I have their free cash flow, their terminal value, enterprise value, minus liabilities plus cash gives me an equity value with the shares outstanding, and it gives me a fair value per share. And on the back end, I do have kind of like, I take into account their market cap, the total debt. I take into account the beta, risk-free rate, market return, again with their debts, and gives me a whack of 6%. And these are just a quick free cash flow intrinsic value. Now, for me, my process is, okay, if it looks profitable here, I have another DCF that's a lot more detailed. It goes into more depth with the income statement and a lot more different estimates and analysis. So looking here, so what my hunch, I think they're going to be here somewhere in the base case, just because, they have a lot of positive things going for them, but I don't think it's sustainable. Honestly, if I had to pick a area where I would be most comfortable with, I would rather get in the low 30s. Because I think like once the hype is over, I think the price will drop back. But it's possible, again, that hype might keep this up. So for me, it's not a buy right now. I would say it's definitely worth putting on your watch list and seeing and doing more due diligence. If you have a more positive outlook on this than I do, for example, if you're saying, okay, I think the best case scenario is what applies to this company, then what you should do is you should do more research. You should look into their new COVID pill. How much revenue potential is it going to bring? You should find out, is the COVID vaccine something that's just going to be sustainable? Is it going to be something normal where every single year for the rest of your lives, our lives, we're going to have to start taking it? Or is it something temporary? Is COVID, if COVID was gone tomorrow, is this price still going to, reach? These are questions you have to ask yourself. So if COVID disappeared, then is this going to drop back to normal range? What else do they have in the pipeline other than COVID? So these are questions you have to ask yourself. I'm not doing that type of research because I'm not that bullish on this. I think for me, I'm going with the worst case scenario, which is the 3061. I'll put this on my watch list. If it ever drops below 35, I would definitely start looking at it. And I would even consider selling some puts at 30. And if they get filled, they get filled. If not, then, I'll get the money for selling the puts. So it's a win-win situation. So that's my take on Pfizer. I think it's a little overvalued right now. If you're a swing trader, there are some positive things that may come out. You may want to consider taking it as a swing trade. They're definitely going to get a lot more hype once they get their FDA approval for their COVID pill, which the research shows and looks like they will get their FDA approval. So if you want to do it as a swing trade, then by all means have at it as a swing trade. As a value investment, my personal opinion, I would hold off until those questions I asked are answered, until that research is done. And if you still truly believe in it, then, go ahead and make your investment at your own risk. If not, if you want to play it safe, I would say for me, my safest play for me personally, if I was going to invest in it, I would sell some puts at 30. If I can get them at that price, then I think I'm getting a good deal. And that was my video. Thank you for watching. See you on the next video.